to you.
Hello, everyone. Thank you so much for coming. I really appreciate this opportunity to share what I'm passionate about with you guys. So I'm Olaniwaju Owolabi, as you can see. I'm a member of the O5BM. This is not the first time I'll be doing a presentation for them. I did one that was quite successful last year. Off the back of that, I was able to review quite a number of our policies. And for those that didn't have one, I was able to set them up. For those that had a long time ago, I was able to have a look into their policies and to see where the shortfalls are. So I'll be talking a lot about my experience reviewing over 50s men and what I've learned across the months that after the first presentation. So we don't have much time, so I'm going to go straight into it. If you have any questions, please write it down. I'm here to answer as many questions as possible. I know it stops at 8:30, but I can stay as long as you want me to. Okay, so we're going to dive right straight into it. So insurance shortfalls of Black men over 50. Okay, let's go straight. Next slide, please. So yeah, talking about wealth creation, insurance is a form of wealth creation. So I'm sure a lot of people don't know that. So why do we take it? Ensure our loved ones are financially secure, replace lost income, so your family isn't forced to make drastic lifestyle changes when you're not around. So to clear outstanding debt, so preventing financial burdens from falling on your loved ones, which could, and to fund education so children can pursue their dreams without financial strain. For those of us that have our children in private school and want to go to universities abroad. So preserve generational wealth, ensuring assets are passed on efficiently without being heavily taxed. So these are some of the reasons why we take insurance for wealth creation. Let's move on. So let's address some elephants in the room. I think you might want to write these things down and take note of this. Did you know that even if your mortgage is paid off with decreasing term insurance, some of us have decreasing term insurance, in event of death, the government still asks your beneficiaries for 40% inheritance tax on the property after exemption. So imagine you having a lot of properties and then God forbid you pass away, the government wants your family to pay inheritance tax of 40%. And they want it immediately. They want it within 6 months. Did you also know that after 40% inheritance tax has been levied on your mortgage, the remaining 60% goes into probate? And probate is a legal process where a person's estate is administered under court supervision, and it can take a long time, which your family may not see for up to 2 years, even if you have a will. And also, did you know that the 7-year rule means that the government can tax assets passed to your dependents unless you live for 7 years after transferring them? So if you want to have a quick way of disbursing your assets to your dependents, if you know you're going to kick the bucket, but you have to wait for 7 years, otherwise the rule still applies. So did you know that terminal illness is not the same as critical illness? I'll be talking about this a lot more further down the line. And did you know that rented benefits are only available when you are still employed with the company? These are people that have benefits with their company, that have life insurance, death benefits, and illness benefit with their company. So it's only when you're with them. It's just a loyalty sort of thing. So we can move on to the next slide, please. Right. Reasons why Black people pay higher premiums. We have lower life expectancy. Unfortunately, our life expectancy, as opposed to the Caucasians, is like 7 years. And this is what they found out. And it could be from diet, the way we exercise or we don't exercise, or the kind of lifestyle that we live. Thank God the over 50s Black men are now pushing table tennis, which is very good for a lot of us. So one thing I found out while doing a lot of our policies is chronic health conditions, which affects a lot of Black men, hypertension, and Black women too. Diabetes, heart disease, hepatitis, mostly skyrockets the price of the cover. And sometimes it becomes difficult for them to get cover. So Lack of access to best providers. Some providers are not advertised on the open market, which people don't know about, and they're very good and they're very accommodative. So without this knowledge, you can struggle to get cover. Next slide, please. Now, the insurance shortcomings. Income inequality affects us because of economic disparity and limited savings, which a lot of us struggle with. Lack of employer-sponsored plans. Some people are self-employed, they work on their own, or they work with small companies that can't give them these plans. So death in service benefits is one of the employer-sponsored plans. Private medical insurance, like I said before, and critical illness benefit. So, but the flip side to this is, even if you do have these employer-sponsored plans, and then you leave the employment, you become uninsured. And sometimes you become uninsurable. So because of age or medical disclosures. Insurance myths. There's a misunderstanding of need. Protection still needed when children are grown or after mortgage has been paid off. So it's not just for the mortgage or for the children when they're young. It's to pass on generational wealth to your children, tax-efficient wealth. And there's a cultural stigma amongst our people that it's difficult for them to talk about death. Nobody wants to talk about death. So I remember when I went to my auntie and I told her that let's talk about your life insurance, just in case you die. Over my dead body. I would never die in Jesus' name. I said, auntie, you just said over your dead body now. That's what I'm talking about. We're talking about the same thing. This man. So let's move on to the next one. So we have we need to understand insurance speak. And there's a quite of things we need to go through. I'll go through it patiently with us so that we understand. Now, understanding your policy. Some of us, we've had policies for a long time. We don't even know what we have. So, or what it covers or what it is. So let's talk about some of these policies. Let's talk about the critical illness first. This actually pays out a tax-free lump sum on diagnosis of certain life-threatening or debilitating but not fatal conditions, including heart attack, stroke, cancer, and major organ transplant. What does it mean? It really means serious illness that can be life-threatening, that requires significant medical treatment. And who needs it? People who have no policies at all, or family breadwinners. So if where the money is coming from, if something affects you, it affects the whole family. So you need it to cover the shortfall. People in full-time employment needs it. Individuals paying mortgage or rent needs it, because if you don't continue to pay your rent or mortgage, you know what could happen. Now, terminal illness is different to critical illness. Terminal illness basically is a disease or condition that cannot be cured and is expected to result in a patient's death, typically within a short period of time, often estimated as 12 months or less. Examples are advanced cancer, stage 4, or organ failure. So what does it mean? Diagnosis of death, really. And we know that a lot of people, sometimes they get diagnosed of death for a certain period of time and they live further than that period. So it doesn't mean you're going to die within that time. So, but anyone that can take out a life insurance cover will have a terminal illness. It's actually usually comes with the life insurance. So if you have a life insurance, you also have a terminal illness with it. So you can get your life insurance cover whilst you're still alive if you're diagnosed with a terminal illness. So anyone with a critical illness cover will also have a terminal illness benefits to it. Now, income protection for everybody that's still working pays out a regular tax-free income if you're unable to work due to an accident, sickness, or disability. So it helps replace portion of your income. They can't pay the full amount of your income, usually about 60, 65, or 70%, until you can return to work or retire, depending on what you take. And people in full-time employment take this. And contrary to a lot of people's belief, people in self-employment benefit more from income protection. They can still be covered. So there's life insurance, which everybody knows. It's sometimes known as life assurance, helps provide financial security for people who depend on you should you die. And your beneficiaries get a lump sum if you pass away within the policy term, or you pay the lump sum on your terminal illness. And also anyone who has dependent needs it. Anyone who wants to pass on generational wealth needs it. So that's with this slide. Can you move on, Mr. Kane? Right, there's the whole of life insurance for funeral expenses. We get this bombarded on us every day on the media. They call it the over 50s life cover, over 50s insurance, suitable for people over 50 with no dependent children. That means your children are all grown, over 25, and they're doing their own stuff. Pays out upon death of the life assured or diagnosis of terminal illness with life expectancy less than 12 months. But one thing we find out about these policies, okay, it's actually for lifetime. The good thing about it is for lifetime coverage, funeral and for funeral expenses. But it's usually quite expensive. And sometimes it has increasing premiums as you go along the years. It covers very little, but because it's meant for funeral, really, so that you don't burden your family with funeral. People with no policies, over 50 with health issues. Okay, so, but then again, you have to be careful. If you're not careful, you can end up paying more in premiums than what you're covered for. Because I've seen people that they're paying like 30, 40 pounds for their cover, and they only cover for 7,000 pounds or 8,000 pounds. And they have it till for life. So within 4, 5, 6 years, they've actually paid that amount. They paid it all off. So, and they're still paying. So it's better to get term if possible. But sometimes it's difficult to get term if you are ineligible because of health reasons. So you've gone to different providers, they can't cover you because of health reasons. The good thing about this whole of life is that they don't look at health disclosures. They cover you notwithstanding, so individuals not wanting to burden their families with funeral costs is good for them. So decreasing insurance, we also have to talk about this. This is what the mortgage advisor would tell you to have when you're taking out a mortgage, and it's meant to cover the mortgage. It doesn't cover your family, it covers the mortgage. So it's commonly used to cover a repayment mortgage as the payout decreases over time, matching the reducing mortgage balance, and pays off fully by the end of the term. So what it means is that as the mortgage balance decreases, the insurance payout reduces, leaving nothing for the family. So you have a mortgage that is paid off, but nothing for the family. But then again, you still have inheritance tax to pay on the mortgage. So when you want to ensure that your mortgage is paid off, that's when you take this. But I'll always advise you to go for the level term, which is the next one. This is where the amount you pay and the cover stays the same during the policy term, unless any changes are made to the policy. So it just maintains its value throughout. So level term insurance provides a fixed lump sum payout if you pass away during the policy term. So helps cover expenses like mortgage. You can use it to cover the mortgage, education, bills, lifestyle costs. Payout amount stays the same throughout the term, ensuring consistent support for your loved ones or for your family. Now, for every one of us here that has a business, whether you have a business that you're you're working, you open a business to do your work. So you could be in healthcare, you could be IT, you could be, so if you have a business account and you have a business that's registered here in the UK, you can take Relevant Life, and it's very good. Relevant Life is like a life insurance, but it's paid by your business. So what are the benefits of this? Relevant Life Insurance is ideal for businesses wanting to provide life cover for key directors or employees in a tax-efficient way. So the premiums paid by the director are usually treated as a business expense, which means you can write it off at the end of the year. You write it off as a business expense. You don't pay tax on it. So it's like you're having free cover for throughout the year. So company directors or high-earning employees or small businesses can take it. So it's very, very good. So it's something you ought to consider if you have a business. Next slide, please. Now, the big thing is the trust. We have to talk about trust. I'm sure people have heard of trust fund. What is a trust? A trust is a legal arrangement where a trustee manages assets for your beneficiaries. A life insurance trust is formed when someone transfers ownership of their insurance policy to a trust. So when people pass away in this country, everything that you own, your assets, investments, anything that you own, it goes into what we call your estate. And your estate is now valued, and a 40% inheritance tax is applied onto your estate. That goes to the government. That is a huge sum. And your insurance policies are not exclusive from your estate. So if it's not put in trust, it's part of your estate. So you will avoid, if you now put your policy in trust, you will avoid paying 40% inheritance tax on your estate, and your beneficiaries will get full payout in less than 2 weeks. Because when you set out a trust, you put instructions on who gets what in terms of their percentages, and it's dispersed very, very, very quickly, because the trust gets the money immediately and disburses it to your dependents or your beneficiaries. So situation where it's needed when you want to pass on tax-efficient wealth to your dependents. Now, these are some of the benefits. Now, the benefits, another benefit is a waiver of premium. For those people that are scared that your income might not be steady all the time, you might struggle paying a premium. If you have a waiver of premium in your policy, which waives insurance payments if the policyholder becomes critically ill, injured, or disabled, or even if you're going through, if you're going to redundancy, it helps prevent financial, it helps prevent financial hardship by covering premiums when income is lost due to ill health also. So that means that they will stop taking the premium at that time. Some of them would stop for 6 months, some of them will stop for 12 months, and then, but your policy will still be in place. So you're not going to lose your cover. So your policy would not lapse from financial hardship, avoiding the risk of higher premiums or losing coverage when reapplying. So situation where it's needed when incapacitated due to illness, injury, maternity, or paternity leave is also included. So I don't think any one of us over 50 is thinking of paternity leave now, or I might be wrong. So your guarantee. So guarantee is policies where the premiums are fixed for the entire term. So you take out a policy, £30, say for instance, and you're covered for like £200,000 for 30 years. For the next 30 years, it's not going to go a penny over £200. So £20 or £30 rather. So the premium is locked. The guarantee, the policy payout is also locked. So your policy premiums and your policy payout remains the same throughout the term. When you want consistent premium payments, you want to know what's coming out of your direct debit for the next 30 years. Now, the opposite of it is indexation. With indexation, it safeguards your coverage against inflation, and it ensures you meet the need both now and in future. So what they do is they review your policy every year, every 2 years, every 5 years. And they look at the percentage of inflation. And what they now do is they apply that percentage to your policy premium and to your policy payout at the same time. So when you want your payout to be relevant at point of claim in line with inflation rate, that's when you take out indexation. But you don't have a control as to what the charges will be. Okay, next slide, please. So fracture cover is an added cover to optional add-on to critical illness cover. If you do take it, is to ease the financial impact of injuries from everyday accidents like slips, car crashes, or falls. It helps with the extra costs such as childcare, travel costs. You can claim up to £4,000 every year on this one. So it covers things like when you're playing football with the boys or table tennis and you fall down and you hurt yourself, you can claim. And if you're involved in any accident that prevents you from doing your normal day-to-day activities, you can make multiple claims in a calendar year on this, like car crashes, slips, or falls. Now, another beautiful thing is the unlimited access to private GP 24/7. Now, even if you take a policy of £10 with some of our providers or some providers, anytime GP will now apply to you, your partner, and your children. And this is all year round, 24/7, anywhere you are in the world. It means you can receive unlimited advice, reassurance, diagnosis worldwide. Call to schedule a video, phone, or consultation. Even if you're in Nigeria, you can actually call them if you're experiencing any symptoms. They'll take it over the phone, do a diagnosis, send you a prescription via the email, and you can use it to access the pharmacy or a chemist. And that's the unlimited access. It's a beautiful policy. Most of our families love it. Next slide, please. Right. I'm just conscious of time. Now, let's look at accessing the best providers in the market. There's some providers that you wouldn't normally get on the market that their product, they want it to be advisor-led. They don't want people to just buy it off the shelf because they won't understand it. They want an advisor to explain the product properly to them. So Guardian is one of them. Incidentally, I have mine with Guardian. So with Guardian, they're very good. They pay out critical illness on low-grade early prostate. And a lot of our men, in the past, they've taken it out. So if they have a diagnosis of low-grade prostate, they pay your critical illness claim. They pay out on type 1 insulin-dependent diabetes, pay on third degree burns, which is like 5% burns. And with the beautiful thing with Guardian, you don't need to fill a claims form. All you need is a GP report. And they also have the 24/7 private GP for the whole family. So it's advisor-led. So situation where it's needed, people who need access to broader coverage or illnesses, people who need larger number of providers to choose from, and people who need access to more benefits. So with Guardian. Now, legal and general, most people know legal and general, but they give life cover is easy to get with legal and general, but they need advisors to lead to advise on income protection and serious illness cover. So those ones are advisor led. So some of their benefits, guaranteed insurability. Their guaranteed insurability is if you take out a policy and then you're insured, that you want to increase that policy. Say, for instance, you take out a life cover for 200,000, and in a few years' time, you buy a bigger house and it's worth 500,000. You want to increase that policy to cover the cost of the house. You can, as long as you're ready to pay the associating premium, because they've already taken your health records. They've done your underwriting already. So they've got well-being support, helps clients get through mental and physical health issues, and they have private diagnosis for an additional £4.50. And they have hospitalization benefits, which means that when you're in hospital, they keep paying if you're admitted in hospital for as long as you're admitted. I think they pay up to £150 a day. I don't know, for some people, they won't want to leave that hospital, but that is it, they pay. So next one, please. And then we have the Vitality Life. Everybody also knows Vitality Life. So Vitality Life rewards you with Optimizer. Optimizer is one of their features where they want to see your activity level. So if you are active, they also give you discounts for the gym membership. If you are active, you're moving, after they review your policy for that year, they can reduce the premium. That means you're active. You're doing healthy things. How do they monitor you? They give you an Apple Watch to track your activity, to see whether you're moving, whether you're not a couch potato. You know what I mean? So with this one, it's complex underwriting and rewards with a reward system. So they need advisor to lead the policy cover. No, and then with this, it's the same situation where it's needed. People who need access to broader coverage of illnesses, larger number of providers, and people who need access to more benefits. Next slide, please. Now, there is a belief that assets will support your family after death. So some people I've spoken with, they tell me they have properties and they're okay. And they believe that assets such as real estate, land or buildings, cash in the bank, other tangible assets will provide for the family after death is common, which is not bad. But however, these assets are often subject to inheritance tax upon the owner's death. That's one thing they haven't actually looked at. So we have to keep looking at it as a people. And inheritance tax is levied on deceased estate, potentially reducing the amount passed on to beneficiaries. Now, proper estate planning, including wills, trust, or life insurance, can help mitigate tax burdens and ensure the family is adequately supported. So understanding tax implications is crucial to preserving wealth for future generations. It's very important. This is very self-explanatory. And yeah. Now, another question that I get asked, or what people say, is that, we know insurance companies, it's easy now, they'll take your money, but when you want to claim, they come up with all these excuses and all these clauses and all these things that they say that they want to pay, they will want to shy away from paying. Now, in the UK, 96.9, I think a few years ago, it was 97. 96.9% of life insurance claims are successful. However, there's a small handful of occasions when a claim cannot be declined. If I can ask you now to go on Google and type into Google, what is the success rate of life insurance policy claims in the UK till today? It will corroborate this evidence. So a lot is successful, a huge number, but the minority isn't, and I'll tell you why. Now, if you fail to give full disclosure at the start of your policy, when it comes to the claim period, you will probably have problems. And full disclosure is telling your your provider everything about you that they ask. So if I ask you, for instance, do you have diabetes? You tell me no, and the provider looks at your health coach and say, oh, this person is okay, we can give him cover, without going to your GP. They will give you cover. But when it comes to the point of claim, they'll ask your GP that on the 27th of 3rd, when this guy, of 2025, when this guy took out his policy, he said he didn't have diabetes. Is it true? If the GP says it's not true, it has. What they'll do is they can either decline to pay, they can reduce the pay, or they can do virtually anything that they want to do because you put yourself into their hands. So you have to be very truthful. Then fraud. Some people commit fraud. We sometimes had meetings with the providers, and they'll tell us that funny stories. And people sometimes, one person incidentally went to Spain, went to a remote village in Spain, and told his family to claim on life insurance that he's dead. And they came out with a fake life death certificate. But the insurance people found out. I don't know how they found out. So those claims, that policy will be cancelled. High-risk activities. High-risk activities are like bungee jumping, skydiving. These are some of the questions they ask you when you want to take out a policy. But if you now die through bungee jumping and they find out that you've been doing bungee jumping for a long time, and you say you don't involve yourself in high-risk activities, they won't pay out. Suicide clauses. Now, thankfully in the UK, they pay on suicide, but not in the first year. So if you take out a policy, I only really have fun with my clients. Like, if you're planning on committing suicide, just wait for the second year. Don't do it in the first year. So in the UK, they do pay on suicide, but not in the first year. But in America, they don't pay on suicide at all. So policy expiration, if the policy has expired, they won't pay. And the possibility of beneficiary involvement, you'll be surprised. This happens a lot in America, where the beneficiaries know that, okay, if this guy dies, I'm getting $1 million. So they can arrange to give him something, So, but if they found out that the beneficiaries had a hand in the death of the insured, they won't pay out. So it's very important that you tell your families that. So I have my policy. I've given it to my family. They have my certificate, and everybody knows what they're getting. But I told them this, that you better be careful. Don't start having ideas. Anyway, if the policyholder doesn't pass away during the time of the policy, they won't pay out. And if you fail to pay your premiums, they won't pay out. These are the reasons why they don't pay out. But otherwise, they are bound by FCA rules. In this country, it's governed. They have rules and regulations, or they could get done. All right. Why existing all right. Okay. Next slide, please. Oh, sorry. Why existing policies need review every 5 years? So these are for people here that has actually got policies in place, which I'm sure a lot of us has. Existing policies need review every 5 years because you should ensure that they align with your current financial situation, family needs, and goals. So life changes such as marriage. Some people were married to one partner before, and they've divorced or married somebody else, and they've forgotten to change their policies. It could affect them. Having children, so maybe they had 3 children when they took the policy, they had another one, and they haven't put the name of the child into the policy. No, buying a home. So you were living in a flat when you took out the policy, and then you moved to a big house. You need to cover the cost of that house. So weight loss. Will you know that if your BMI is high, you are big when you took out the policy, and if you reduce your weight, and if you go back to the insurer, they can reduce the premium. They do that. So if they know that you're living healthy, you lost weight now, they'll reduce the premium. The same thing for smoking. If you were smoking when you took out the policy and you've stopped smoking for over a year or so, they'll reduce your premium. Career advancement can impact coverage and requirements. And this is for if you have income protection and you're covered for a certain amount of income, and your career moves up and you're earning more, then you have to review your policy so that you can get covered for more. Additional reviewing of your policy helps identify potential cost savings, better rates, updated features, and may better suit your needs. So regular reviews ensure your coverage remains adequate and relevant. Next slide, please. How are we doing for time? So yes, I wanted to get this done in 30 minutes so I can have time for questions. So you need to get your insurance review done. Very, very important. Yeah. You need to put your assets into trusts. Very, very important. It's including your life insurance if you have one. You also need to make a will. Very, very important. And then you understand more about probate. I think we're having a session on probate. A probate expert is coming soon to talk to us. So you have to get all this done. these things done. And thank you so much for your time. It's going to be a short presentation today, but I hope we've learned a lot. I'm ready for your question.